We'll get started. Good morning. I'm Jennifer Perry from INCA, the Adirondack North Country Association. Thank you so much, everyone, for joining us this morning. I'm extremely excited to dig into the topic of clean energy financing for energy projects. Just a couple of quick housekeeping items before we dive in. This is an intimate group, so we're hoping for a lot of dialogue, a lot of back and forth, give and take. We want to hear from you as much as you're hearing from us. So you will be muted, but you have the ability to unmute yourself if at any point in time you want to hop in with a question or a comment, or can't hear something if something's not working. But also, if you have any questions, comments, feel free to put them into the chat. We'll be monitoring the chat box throughout. We will be recording this presentation. If you are not comfortable with that, please fire us off a message or say something in the chat box or speak up at this point in time. And that's basically it for housekeeping items. So I'm going to dive in. Again, I'm Jennifer Perry with the Adirondack North Country Association. And this presentation started because we have worked very hard in combination with EIC over the past few years to bring property assessed clean energy financing to the North Country, and we are really getting at a critical mass at this point where, with multiple counties not enabling this game-changing legislation, but we're finding that the uptake of the financing to finance clean energy projects is a little on the slow side. So we are wanting now to really begin to the lending aspect of this, not just with PACE, which we're going to hear a lot about what this means shortly from Susan, but as a concept in general, as an opportunity to more from a lending perspective to support your community for clean energy projects, but also in a business model too, as an additional suite of services portfolio that you can offer to do your thing. It's a little bit different. There's some nuances about clean energy financing, and we're hoping to start the conversation to educate folks about what that looks like and again, what those opportunities might be. We would love to hear from anybody on the call if there are any barriers or concerns. So that's part of the point of this conversation. So I'm with ANCA, the Adirondack North Country Association. And just for anybody who is not aware of what ANCA is, we have three general programs. One is food systems, one is the entrepreneurial economy, and the third is what we work in, which is clean energy. And if anybody has any questions about any of our other programs, feel free to reach out to us at any other time, and we'd be happy to dig in and have a more in-depth conversation. So I thought that I would really briefly introduce our presenters today. The first is going to be Susan Morth, and she is the CEO of the Energy, I'm sorry, whoops, I wrong button. Sorry about that. The Energy Improvement Corporation, and Susan, sorry, I have a bar that is right over the word. So I will.
No worries, I'll introduce myself briefly.
That would be perfect, that's better, thanks.
No problem.
During your presentation or now?
Oh, I can introduce myself now. So I'm the CEO of EIC, which is the Energy Improvement Corporation. We're a New York State CPACE program administrator. And we operate a program called Open CPACE, which launched at the end of 2019. The program has been very successful. We have many financings under our belt all around the state. And are looking today to talk to local lenders about the opportunity for PACE, for banks to participate in our program and lend CPACE to their own customers. So thank you for the invitation to be here today.
Great, excellent. And Susan will be our first presenter shortly. John, also, I think that's actually a pretty good approach. We'll just let everybody introduce themselves when it gets to their time to chat, but John is with NYSERDA. We're very excited to have his perspective, and he will also, at his point, talk to you about what NYSERDA is, if you're not familiar with it at this point in time, and the different opportunities that NYSERDA has to offer. And our third guest today is Bill Peterson, who is the Senior Vice President and Senior Lending Officer at Amalgamated Bank. Also give him the opportunity to introduce himself. So again, we're extremely excited to have the powerhouse of presenters. Before we dive in, though, I do want to see, for our guests and for our purposes, who is in the room and what kind of perspectives you bring to the table. So I'm hoping to just do a quick round house, and I will call on your name so it's pretty clear who it is that we're talking to. So again, I introduce myself, Jennifer Perry. I'm an energy circuit rider with the ANCA Clean Energy Program, and I'm just going to go by my grid. So the next person in line would be Matt Price.
Morning, everyone. As Jim said, I'm Matt Price. I'm also an energy circuit rider at ANCA, and I am based out of the western part of the ANCA service region in Jefferson and St. Lawrence counties. So I'm really excited to learn about the CPACE program. I'm fairly new to the energy world, so this is more of a learning experience for myself. So thanks, Jim.
Great. Nancy Bernstein is next.
Good morning, everybody. Nancy Bernstein. I'm an energy circuit rider with ANCA. I've been here for going on 5 years and always learning more about CPACE. Every time I hear a presentation, I learn a little bit more. So I'm really looking forward to this. Thank you.
Excellent. And Kevin from Lewis County. You're muted, Kevin.
Sorry about that. Still happens, you know, the year is this. So I'm Kevin Briard. I work for Lewis County's Planning Department, and I coordinate kind of our actions towards the Clean Energy Communities Program. Lewis County just authorized CPACE in 2021, so we're looking forward to taking advantage of this program.
Awesome. Jared.
Yes, good morning, everybody. Jared Bly, I manage the Clean Energy Program at ANCA, and just wanted to start off by thanking the presenters for being here this morning and sharing their time and expertise with us. It's an exciting topic to learn about CPACE and, really the true potential that it has for kind of unlocking these technologies to get us toward carbon neutrality, but also just kind of reduce energy spend and help with operations. So it's just one of many tools in the toolbox, but happy to learn more about it. Hope you all are as excited as I am, and just want to also thank everyone who's joining the call this morning to get to also provide your time to learn about this. So thank you for being here, and I hope you learned something.
Great. Thanks, Jared. Annie.
I'm Annie Arnold, and I'm also an energy circuit rider at ANCA. I work under the Clean Energy Engagement Program. I'm also new, as Matt is as well, and I'm excited to explore more about what CPACE is and how it can practically be played out.
Great. Thank you. Diane.
I'm Cheyenne Styria. I'm the Director of Finance and Incentives for the Lewis County IDA, and Kevin kind of brought me in to this conversation a little bit, and I'm just learning now about CPACE.
Awesome. And Jeremy.
I'm Jeremy Evans, CEO of the Franklin County Economic Development Corporation, which is the IDA and LDC for Franklin County. And Franklin County has been in CPACE for a couple of years, and I'm always looking to learn more too, because I know we've had a couple projects interested in CPACE who have run into issues with lenders who are not necessarily comfortable. So the better I understand it, hopefully I can, and along with Russ Kenyon, we can try to help that conversation along so we can get some projects in CPACE in Franklin County.
Jeremy. That's awesome. And Russ.
Good morning, Russ Kenyon with Franklin County Economic Development. Work with Jeremy. I just wanted to start by thanking my friends at ANCA and Jen and Nancy in particular, and Susan as well, for putting this on and getting more information out about PACE. Piggyback on what Jeremy said, I think Franklin County, Susan can correct me if I'm wrong, but I think Franklin County was either first or second to adopt the new CPACE program. So we're excited to, first, great, thank you. To have this program in place. We've not seen it utilized as much as we would like to, so we're excited to get more awareness of the program. Thank you for us.
Great. Yeah, and thanks to Russ for initiating this conversation. I'm really excited that we've gotten to this point. I apologize if I mispronounced, but Alain.
Yeah, hi, good morning. My name is Alain Pierrot. You don't worry about the pronunciation. I'm actually the CEO, CFO of EIC, and I work with Susan Morph.
Excellent. Great, nice to meet you. Mike, I think that's Mike Roach.
Yeah, good morning, everyone. Struggling with my audio and video buttons a little bit here, but Mike Roach with RER Energy Group, and we are a renewable energy project developer, passionate about bringing renewable energy to the Adirondack North Country, and so interested to understand all of the tools that are at our disposal to do so. So thank you for having this event.
Thanks for joining, Mike. Carol Labrice.
Good morning. I'm with the Essex County IDA.
Very good. Thank you so much. And there's somebody showing up as BPG 101. Okay. Well, if that is someone who would like to chime in and introduce themselves, that would be great. Did I miss anybody? Okay, great. Well, with that being said, I'm really excited to have a pretty broad range of perspectives, so I will happily turn it over to Susan.
Well, great. Thanks so much, Jennifer. And thank you, everybody, for introducing yourselves. I'm really hoping this can be, super interactive. It's a small enough group, so jump in with questions. I think it'll be a much more productive conversation if it can be, two-way. So going through Jen's agenda to talk about CPACE and sort of an overview as to what CPACE is. CPACE is an alternative financing mechanism for property upgrades that improve the energy efficiency, allow property owners to utilize renewable energy and so forth. CPACE has to be enabled at the state level. And that happened here in New York, more than 10 years ago. There was a state law passed called Article 5L that says if municipalities wish to, they can offer PACE, property assessed clean energy, to property owners within their jurisdiction and allow the municipal assessment to be used as a way to enable this alternative financing mechanism that would be different than bank lending in that, one, it's 100% of the financing can, the 100% of the project cost can be financed. And very importantly, the terms can be much longer than a typical bank would lend to. So for example, if a property owner does puts solar on their roof, generally speaking, banks don't like to lend more than sort of an 8-year or 10-year time horizon on those types of projects. But through PACE, the term can match the weighted useful life of, for example, that solar installation. So the property owner can spread those payments out over 25 years. And in the case of solar, they're saving money every year on their electric bill. So they can use those savings to either partly or fully offset this once or twice a year assessment. So it's a bit different than bank lending. It does have some attributes that work for certain property owners better. It's not for everybody, it's just a choice. And as Jennifer had said earlier, PACE is one of the tools that property owners can look at when they're trying to accomplish energy efficiency on their properties. So jump in if anybody wants me to go deeper into the CPACE overview. This was meant to sort of originally talk to the issue of banks. And I think that several of the municipalities on the line, in particular Franklin County, has run into issues with banks saying, well, we don't want to be subordinated by PACE. And what I mean by that is because CPACE is a municipal assessment, it has a priority lien status over the municipality's property taxes. So in our program, if a property owner were to fall on hard times, not pay their taxes and not pay their CPACE assessment, eventually the property would be foreclosed upon. The municipality is in the first position in our program, which means they are made whole before anybody touches the money. Next would come CPACE, we're subordinate to you. But after CPACE would come the senior lender. So anyone that had a mortgage on the property is being subordinated by this charge, which is why we in New York State and in most other states require lender consent. Again, getting back to Franklin's conundrum, that lenders look at this and say, well, why would I consent to that? I'm not doing that. So let's talk about, why a bank might want to consent to CPACE. So normally what happens, and this is definitely the case in New York State, there are rules about what can be paced. And in New York, NYSERDA, which we'll hear from in a little bit, has the obligation to be the party that sets CPACE guidelines. And in New York, in our state law and in our NYSERDA guidance, it clearly states that PACE is for saving energy. So in New York, you have got to have energy savings from your project, or you can't use PACE. It can't be used for economic development. It can't be used for vague things. It has to be used for energy savings. So NYSERDA has CPACE guidance that lays out what types of improvements you can use PACE for. And it's all very logical, makes a lot of common sense, and is extremely excellent guidance in that it allows property owners a wide range of measures that they can use PACE for. But at the end of the day, the total pile of those measures has to save energy over the term of the project. So banks are consenting to something that is going to make the property more valuable and also is going to reduce operational costs. So that's something that a bank would want to look at. If I'm consenting to a project, what is it? And what are the projected savings from what you're doing? If you're putting in ground source heat pumps, you're adding solar, it's pretty clear that these measures are going to be a positive for the property owner, a positive for their cash flow, and are improving the value of the property. So it is, it's an individual one-by-one analysis that should be done by the senior lender to say, does this make sense or doesn't it? And fortunately in New York State, because of our state law and because of the NYSERDA CPACE guidelines, normally it does make sense. But getting more specific, one of the things that I wanted to talk about was acceleration. So CPACE is a municipal assessment, just like property taxes, and CPACE assessments cannot be accelerated. So while the full assessed amount is recorded on the property record, only the annual payment can be collected, even in a default situation. So the past due portion that's senior to a mortgage is typically going to be a very small percentage of the property value, 1%, 3%. It's not a big number. So for example, if we were to consider a $1 million CPACE financing on a property that was valued at $5 million, the annual assessment for a 20-year term financing would be about $87,000. So if the property owner did not pay the CPACE assessment in year one, the funder could only collect the delinquent payments. So by the time a municipal foreclosure process were to happen, say it's 3 years that you give somebody 3 years, you're really only looking at 3 times 87. So that's a very small percentage of the value of the property. So the really important thing about PACE is it doesn't accelerate, and it would transfer to the next property owner. Just like when a new property owner were to buy a foreclosed property, they would pay municipal taxes, they would pick up the CPACE assessment. The other thing that we'll point out is that the CPACE financing itself doesn't restrict a senior lender's foreclosure rights. So you're not giving up rights to foreclosure. If the senior lender wants to foreclose because the mortgage is in default, the property owner's not paying, they can do so. There's no regulation that says it somehow impacts your rights. So those are 2 important things I wanted to point out. The other thing I'll say is that just like property taxes can be escrowed, banks can say, in order for us to consent to this assessment, we want the property owner to escrow this, whether it's every 6 months or once a year, in a very similar fashion to property taxes. So the bank doesn't have to sit there and think, oh, geez, I hope these people can come up with the money, at the end of the year. So there's ways to sort of safeguard your exposure. The next item that's on the list of questions is the maximum amount of a CPACE assessment that a senior lender would be comfortable with. And again, that's going to be a case-by-case basis. And if you were to look today, at our approved lenders in our program, we have 14, which is terrific. And these are the national CPACE specialty finance companies who represent, the majority of CPACE transactions that have occurred around the country. So they do know what they're doing. However, what they don't have, that I would like to point out to banks, to local banks, is they don't really know their customer. So in a lot of ways, local banks would be terrific CPACE lenders because they know, for example, the Lake Placid area, or they know the Lake Tupper area, the Tupper Lake area. They know, is a new hotel needed here? What's tourism like? What's the volatility in our economy? What do I know about this property owner? Should they expand their fishing lodge? Is that a good idea? So they're very intimately involved with the community, with the lenders themselves, and they can step in and offer CPACE as just an extension to their other lending products, if and when it makes sense for their customers. So it's my view, it sometimes is a really good idea to try to keep things local. And I will tell you that when I talk to large and very prominent developers around the state, those developers in Lake Placid, those developers in Albany, in Buffalo, they fully understand the scope of choices. These are experienced people who are well capitalized. They can borrow money from a lot of different places. They are interested in energy efficiency and renewables. They are very interested in PACE, but they also say, gee, wouldn't it be great if my local bank was participating in this program? So, part of the reason I'm here today is to sort of educate everybody about this opportunity. There's no reason that banks can't participate in PACE, and we're starting to see some of that. We have our first bank on our approved capital provider list, which is Western Alliance Bank, and they've been involved in some CPACE transactions on the West Coast. They are trying to bring their efforts here to the East Coast, but it would be, much better for all of us in this group to hear M&T Bank, Key Bank, banks that we know, offering CPACE in the program. So the next question on the list is loan to value, LTV, and what makes sense. Most CPACE lenders are limiting the LTV to 90%. And again, that's really, we leave that in the hands of the lender, the CPACE lender, to decide what they feel comfortable with. And also, of course, mortgage, if you're going to be consenting, that's, a case-by-case basis, what one feels comfortable with. The question after this is interesting because it's one we've discussed with Essex County, and I know we do have a representative on the line from the Essex County IDA. And the question is, if a property owner enters into foreclosure, how easy will it be to find a buyer? So being in Westchester County, I would say, well, oh my gosh, you'd be beating them off with a stick because, there's tons of buyers for properties down here, but that's not necessarily the case in the entirety of the state. It may not be the case in Essex County. So this is where underwriting really comes into play. And another reason we'd like to see local banks involved. There needs to be an understanding if there's a fishing lodge in a beautiful but very rural part of the state, is CPACE necessarily a great fit there? And who are the other buyers? And would there be a long line of people looking to purchase this fishing lodge in a very remote rural place? Maybe CPACE lenders who are based in California wouldn't know that, but someone based in New York State would understand that much more closely. Again, why we'd love to see local banks involved. So CPACE is not necessarily a fit for everything. And if there is a concern on the part of the lender that wouldn't be easy to find a buyer for a property that could enter into foreclosure, they might want to consider limiting the CPACE that they would loan, limiting the LTV. These are bespoke deals and they should be looked at that way. We're not here to sell anyone on CPACE. And Alana and I always make that a big part of our presentation. We're not going to make money if property owners use CPACE versus another financial product. Our job is first and foremost to protect our municipal members who have very graciously offered lenders to utilize their magic dust, is what I call it, your assessment power, which is a really powerful thing that needs to be respected and safeguarded. And that's our primary role at EIC as a program administrator, is to represent and protect our member municipalities so that when CPACE is utilized, municipalities are getting a public benefit. Municipalities opt into PACE to provide a public benefit of clean air. You're not opting in to provide maximum financings in our program, to provide some great new business for for-profit lenders. That's not why you're in our program, and that's not why we're running it. So number one, our job is to make sure that we're following NYSERDA CPACE guidelines, that every transaction we do is an energy savings transaction. We'd like to maximize financings because we'd like to maximize climate benefits, but that's the linkage that we're looking for. So we'd really like, regional banks to consider becoming CPACE lenders, not just so they'll consent to specialty finance companies wanting to provide CPACE to property owners in their jurisdiction, but also we feel the more the banks learn about this opportunity as it relates to CPACE, the more likely it is that they might want to be lenders in our program. And we feel that would be, a great augment to what we already do offer, of course, which is, 14 lenders. So I didn't know if anyone wanted to jump in with questions, but would love to answer any or, get into more detail where there's interest.
That is fantastic, Susan. And you are going to monitor the chat. Are there any questions popping up in the chat box?
I don't see any questions yet in the chat.
Okay, great. It looks like Russ, you might have just unmuted.
I did. I just had a quick question. Could you go back to the statement you made about how banks don't lose their foreclosure rights?
Yeah,
how
sure.
will that work?
Yeah, so effectively, CPACE is not the same as another, it's not debt. CPACE is not debt, right? It's a municipal assessment. So because it's not another form of financing or debt, there's no intercreditor agreement required. So in the event of a default on the senior lender's debt, the senior lender can foreclose in the same manner as if they were the sole financing on the property. So it doesn't change the bank's ability to foreclose on the property. It doesn't affect any existing remedies under any of the bank's loan documents whatsoever. So their documents are not changing with the property owner. There's no intercreditor agreement. So there's no change to their status there. What would probably happen in most scenarios is the CPACE lender would probably step in if the mortgage company didn't step in to kind of work this out. But lenders aren't losing any of their rights. But it is true that if you were to have a property that just wasn't very valuable, and for whatever reason, the senior lender was sort of asleep at the switch, and they didn't realize the property had fallen into disrepair, maybe the property owner lost one of their jobs, and they decided to consent to CPACE because they were asleep at the switch, and the property owner lost the property. And it's hard to kind of come up with a scenario, but certainly it's possible. We don't want to deny that this couldn't happen under any circumstance, because anything could happen. Then you're looking at the municipality in our program is getting their money first. So go back to, no matter what happens, we're protecting our municipal member. And then if there's money left over, it does go to the CPACE lender. But not in an accelerated fashion, right? Only in that fashion of what was owed. Not the whole thing gets paid off, just the outstanding year or 2 years or 3 years, which again is not going to be a big amount as you relate it to the total assessment. So these are important questions that you're asking, Russ. And I think part of it is that banks just haven't had the opportunity to have a very transparent conversation with us as a program administrator and to really, as I like to say, you know, we're going to put everything on the table and everybody can touch it and poke at it and really understand what risks it is they're taking in the program. And then banks can set up their own parameters and say, well, okay, now that we understand this, we're going to restrict the LTVs to whatever they feel comfortable with. And we want to keep our own customers, and maybe we want to, you know, be a lender. So if someone's looking for lender consent, we can say, well, we'll step in and, you know, do the CPACE for you.
Thank you, Susan. That was super helpful.
That's what we're here for. So take advantage, abuse us. We like to talk to people, and, you know, we definitely, appreciate that, you know, CPACE is a great tool, but it's not easy to understand. It's not for everybody. You know, so we're not trying to, I just can't say enough times, we're not trying to sell any property owner on CPACE, but there are a lot of instances where they're going to make improvements to their property that, you know, are scheduled improvements anyway. And hopefully you're going to start to see property owners say, you know, we don't need these oil burning furnaces anymore. Let's pursue NYSERDA programs. Let's get some incentive money into our businesses from NYSERDA to install these ground source heat pumps. There's some great incentive programs, and let's use PACE to pay off those ground source heat pumps over the next 25 years. A longer term, it makes it more affordable. So there's a lot of great things about PACE, but, you know, we're not trying to sell it to anybody as the be all to end all.
Yeah, I greatly appreciate that perspective. Any other questions, comments, any stories anybody would like to share?
Yeah, I don't know how I'm doing on time. I might make one or two more comments. Jen, do I have a few minutes?
Yeah, absolutely. And actually, at any point, anybody can, you know, I mean, interrupt. I think, Susan, you even used the word yelling and screaming, but I don't think it's that kind of a group. But if you want to yell and scream, Susan shared that's fine too. But I would love to hear, if you wouldn't mind as well, sharing a story, a case study that you're capable or able to share with everyone for success.
Absolutely. Thank you, Jen. And I was going to get to that. So if you were to go onto our website, you could see, you know, some details of all of these case studies. But so there have been 2 CPACE transactions in the city of Buffalo, both energy efficiency, both sort of the renovation of existing buildings. There've been a couple of CPACE transactions already in Syracuse, one a renovation of an existing building and one a renovation of the Syracuse Hotel. There have been about 4 in Long Island, and I think 3 of the 4 were solar transactions. There was just a big transaction in Ulster County, the largest in our program to date, which was the construction of a new hotel. So last summer, we were very fortunate to get CPACE for new construction passed in the New York State legislature. So now property owners who are building new buildings can use CPACE for the portion of those, for the portion of the build that is related to energy savings. And there's different ways that property owners can qualify for PACE in new construction. That was a $21 million transaction. So that's the largest one we've seen to date. And the other thing I might add is that CPACE works pretty well for financings between, you know, 250, 300,000 up to, you know, 100 million, you know, can go as high as anyone could imagine. But it's not a great fit for very small property owners that are doing small projects, I should say, for a couple of reasons. One, it's expensive to originate a CPACE loan. So the lenders will look and say, you know, can we charge enough in fees, you know, to make this worth our while? And then also our program, one of the ways we indemnify our municipalities, there's a bunch of ways, but starting out in our local law and municipal agreements, EIC indemnifies the municipality, which basically means that no matter what happens, nobody can sue the municipality for anything. The property owner could never sue the municipality. We indemnify them. The capital provider indemnifies them, the property owner indemnifies them in the contracts. So everybody has to sign off that no matter what happens, Martians come, you know, on Earth, you cannot sue the municipality. So that's really important to us. And then on top of that, to make it even more comforting, we require a legal opinion on every single transaction. That means our counsel looks at all the documentation behind the transaction, the administration agreement, all the agreements between us and the capital provider. All those documents are reviewed by our counsel that says, yes, this documentation is correct and is legal. So they charge $10,000 per transaction for that opinion, but it's critically important to our program because it's another big, so now you have our counsel, Norton Rose Fulbright, and all of their partners' capital standing in front of someone trying to sue and say these documents weren't legal. So we're carrying a very big stick to protect our members. And that is a result in part from the experience that EIC had years ago under a different management with a different legal team, and at this point, a different board, where we operated something called a municipal make-whole program that some of you might remember, where the municipalities agreed to backstop if the property owner didn't pay. That program had a lot of flaws and it was closed down quite some time ago to new financings, but it certainly didn't protect municipalities. It involved them deeply. It involved exposing them financially, and it involved exposing them administratively. And our program does not do that anymore. We assume all the administrative responsibility and burden. And again, we're providing municipalities with complete indemnity so that they never have any, exposure to a property owner, suing. So I hope that answered your question, Jen. I got off on a tangent. I apologize.
Yeah, beautifully and more. Yeah, that was extremely helpful. And I would like to comment too that I really appreciate the local perspective. That's very much at the core of ANCA's philosophy and mission. And I really greatly appreciate your concept of public benefit too, and bringing that into the front of a mindset.
Absolutely. And that's the thing that we, at the end of the day, PACE is an asset-backed security. And, my background and Alon's background, our backgrounds are Wall Street, commercial banking. I don't have any background in the environment. I don't have any background in government. What we do at EIC is we create financial products that work, that make economic sense, and that protect all parties, so that we're very transparent. It's very clear who's taking on what risk and where. So, our job is really to provide financial products that make environmental goals achievable. Because at the end of the day, we're dealing with commercial property owners that are looking at the economics. And, you really can't sit back and wish and hope that people have good intentions, because commercial property owners need to make money. They need to operate their buildings. They need to do things that make financial sense. They're not going to do something that costs them money. They're going to only do things that benefit the environment if it benefits them as well. So, we're stepping in to say, we get that part. So let's make sure that our municipalities are getting a public benefit of cleaner energy for extending their assessment power, which we have incredible respect and reverence for that. And we want to make sure that at every turn, our members are getting what they signed up for. So we're not in the business of ever thinking, let's maximize, CPACE financing numbers or amounts. That doesn't matter to us. When we post about our success, we don't talk about the dollars financed. You'll see that we're talking about the CO2 reduction from these transactions on an annual basis and over the life of the project. Those are the numbers that we're tracking. We're required to track that by NYSERDA, which is another big benefit in the New York program. If you were to look at programs around the country, there may be one or two others that are similar in terms of, I really view it as the integrity as it relates to the public benefit. But our program is very strong that way. So we feel, super comfortable talking to municipalities, talking to banks, and property owners about, how we can all work together at a local level to make PACE something that people understand, and hope that banks not just want to consent to it where it makes sense, but also potentially that they might like to participate.
Susan, this is Jerry. I got a quick question for you. You mentioned some of the eligible technologies or measures already, but how narrowly defined is that? I mean, are there non-energy measures such as like seismic retrofits or water conservation or flood mitigation, anything like that can be, is that
Sure.
eligible?
That's a great question. So there can be measures that are sort of ancillary to what it is the property is trying to do. So water conservation, low flow toilets and showers, those are all eligible. But in terms of seismic or resiliency, those are not possible in New York State because our state enabling statute, Article 5L, requires that there are energy savings. So resiliency does not save energy, nor does seismic or fire hardening. Those are clearly climate benefits. And there could certainly be at any point an amendment to the state statute that would allow for resiliency, that would allow for other climate benefits, not just clean energy. But today, as it stands, it is just clean energy.
Thank you.
You're welcome.
That's an excellent question.
Yeah, it was. Thank you.
Anyone else? Good to hear your feedback as well, too, not just questions.
Let me just check my chat button. I don't think we have anything else. Maybe if we move on to other parts of the presentation, please jump back in if any questions come up.
Absolutely, and we'll have some time at the end too, if anybody remembers something, or again, there's always the chat button. So Susan, that was fantastic.
Thank you so much for inviting me.
5 pages of notes. So, and I would say too that this is being recorded, and I as you're talking, I'm just so excited about that, and really eager to have this as a toolbox too for the IDAs and our local chambers, our staff specifically, that we're able to share over time.
Great.
Thank you so much.
Oh, you're welcome.
Great. All right, so next up, we are going to hear from John Joshi with NYSERDA. I will start screen sharing. So,
hi, can you hear me? All right, I got to share my screen here. Just bear with me for a second. Let's see. How's that? Great. Hopefully it continues to work. Jennifer, thank you very much. So I couldn't help chuckle when Susan was talking about banking and ex-Wall Street folks. So I'm another reformed Wall Street hedge fund guy who's now paying homage to climate impact and climate change. So, after 25 years of doing that, I've been now in government and climate impact issues. So happy to be here. Thank you very much. Just to carry the theme forward, as the outline for this program was clean energy financing. That is our core mission at NYSERDA in terms of impact on climate and climate resiliency. So just to give you a brief background, folks who don't know NYSERDA, it's part of your state government under the governor's office. We've got about 350 employees, 1.5 billion in annual budget. Our goal is climate impact, advancing clean energy innovation and to combat climate change issues in New York. I run a small group in NYSERDA called Financing Solution, which actually is starting to grow now, and we do various different programs. We are responsible for some of the guidance under the 5L for PACE as well, some of the enabling guidance. We also do retail lending for green. It's called the Green Job New York program, that has been lending for the last 7 years, and we do lending in the energy efficiency and the renewable at the residential level. The mandate for my group, the way we've structured it, is to expand local capital, regional capital, bring in capital and financing solutions where we can work with local banks, lenders. And so we have a big effort going on right now beyond what we're doing, obviously, in the commercial PACE support. And we've been working with some entities looking to do a residential PACE in New York as well. We've been working with credit unions and the credit union associations to expand local capital. I'm a big believer in, as Susan mentioned, that local lenders have really good insight into their community, and they know what that community can support and how it should, how it needs support from a capital perspective. And we're working toward coming up with solutions, and we have some tool sets already, and we're looking to expand that and working with stakeholders across the board to expand that capability. One of the things I'll talk about is we have something called a loan loss reserve that's already in the market, and it has had uptake from various type of lenders. From I don't know why this.
Yeah, John, your slides were not popping up.
Oh, all right.
I know we were having some technical issues earlier, so I think Sasha may be queuing up the slide deck here.
All right. Is that working now?
How's that look?
Yep, we're seeing it, or I am anyway.
Perfect.
So go ahead, Sasha. Advance 2 slides, please. Next. Okay. So I was going to talk about a program that's designed to support lending in New York, and we issued a loan loss reserve back in I think released it in December or November of last year, and it has taken uptake now with some clean energy credit unions taking that up. We've had a New York small nonprofit green bank take that up as well. And the idea behind that is, how can we support local lenders and even others coming in with products that they want to put into the market, and they may not have that experience as much in terms of what that performance is. So we can provide a share of a credit risk coverage to them. So NYSERDA would provide a coverage to a lender on a portfolio basis, accrued on an individual asset level, in order to support a credit risk profile. Next slide, please. So the idea simply is, as you make loans for clean energy and EE projects, we can help you de-risk some of those, and so that you have a much better understanding of how much risk you're taking on your portfolio. Next slide, please. In the event that an investor defaults, we can pay out up to subject to a maximum portfolio allocation, up to 90% of principal loss and accrued or remaining interest on a yield maintenance basis. So the loan loss reserve basically is, the way it's structured is, it provides a reserve fund. As you issue loans, you accrue a certain percentage, and we'll get to that on our table at the end. And that reserve is available for any asset that goes delinquent or defaults, that's charged off at 120 days. This has been tested in lots of other states as well. It's done really well. It's a great way for NYSERDA to leverage our capital and encourage local capital investment. So the idea here is that local banks, credit unions, and others who may not have a deep experience can come in and have their portfolio de-risked. Next slide, please. Yeah, you can go through. So the idea here, given that it opens up the market to increase the tenor of the loans. We've seen considerable decrease in given the risk profile has changed. We've seen an expansion in where lenders can lend to a broader set of borrowers. They can reduce the cost of the capital, and they can increase the tenor of the underlying loan. Next slide, please. Very simple process. We have a solicitation on the NYSERDA website. I think we didn't include the link here, but we can send that to you subsequently. You can propose a particular type of lending program, and we review that with you. Next slide. We approve it based on the criterion that you have set forth, and then as indicated earlier, you can save up to 90. We can cover up to 90% subject to the portfolio allocation that we would provide. On a weighted basis, for the residential portfolio, if you're doing higher FICO assets, we only cover 10% of that asset. If we do lower FICO assets, we do 35%. On a commercial portfolio, you can get a blend. As you do smaller loans, you get a higher up to 20% coverage on that portfolio, and the same in the multifamily and the nonprofit sector. Our only requirement basically is similar to the CPACE program. There is an energy requirement, but the way we've structured it is 51% of the loan proceeds must go toward projects that are energy and energy efficiency and energy savings. The balance of the 49% can go toward resiliency and community resiliency impact. Next slide, please. So here's a quick snapshot of what the reserve program looks like. We've got $10 million. We've allocated a bunch of that capital now. But if a lender was to come into the market and they wanted to do a residential program up to $50,000 per loan, you can see the attribution in terms of what the coverages are. If you do greater than 660 FICO, we only cover 10% per loan. We start you out with a $500,000 allocation toward your portfolio. If you do lower than 660 FICO, we give you 35% of the coverage. And then we do have a requirement under our Climate Protection Act that 35% of the portfolio must be for LMI communities and for a based on 80% adjusted median income. The other sectors included small commercial multifamily have a higher threshold in terms of the amount of initial funding. I think there's a typo on the small commercial. It's also $1 million, similar to the multifamily and not for profit. And again, we encourage smaller loans in each of those sectors, and so they get a higher allocation. And then the balance of the loan up to a max loan size gets a smaller allocation. This is oriented to make sure that the smaller borrowers are not priced out of the market. In some ways, it's complementary to the CPACE, where Susan's program is 150 and more is much more cost effective. In our case, the $100,000 or below or $50,000 program is more effective in terms of the loss coverage that we can provide. So it's complementary to doing it that way. And the key thing is we don't charge anything for this program. This is we look at this as a contingent grant structure. We don't charge any fees, and it's a simple, straightforward application process that gives you a very solid loan loss coverage. And what we've learned from a national credit union, having this coverage on their program for the residential sector allows them to resell the loans with the coverage as participation loan sale up to up to 75 basis points or up to 100 basis points lower than where they would have sold otherwise in terms of yield in participation sales. So, which is tremendous. New York customers save 50 basis points on their normal offering, and then these folks are able to go out in the market and get secondary liquidity at a much better yield level. So just final, we're open to any type of a structure that is applicable. We've outlined all types of structures that we could think of, but we're open to new business ideas, and we work with the lenders to come up with a solution. I'll give you an example. We worked with a lender working in the multifamily side on solar. There wasn't a direct way to have end user impact at the residential level. What we did with them was the 25 basis points they're saving on their debt facility. They took that and the savings, and they would pledge that to workforce development in the community. And so that's a way for us to get additionality beyond the climate impact that happens directly by converting or adding solar or geothermal or other types of assets on buildings or residents. I think that should cover it. I'll open it up to any questions, and we can get into more detail. And then this is my contact information if you want to get a hold of us.
Fantastic, John. Thank you so much. Any questions?
Oh, I think I see a question. No?
Yeah, John, this is Jared. I got a question for you.
Yeah.
I did some research on this program prior to this, webinar, but it looked like the program covered mostly mechanical system upgrades, energy efficiency, energy conservation, or on-site energy technologies. As we make this transition into vehicle electrification, is there any talk about extending it to that type of technology being eligible?
Yeah, so
if the site host is, a building or whatever it historically target.
Right. And I think we may have spoken about that, but in one of the sections, section something, subsection G or something, it says there, and we thought about this when we were putting it together. Can we think of everything? No, we can't. So we put in a simple statement in there that says if there's a business model that we've not thought about or a structure we haven't thought about, please propose it. And then it has the requirement is additionality. Climate additionality or other resiliency additionality, given that only 51% of the capital has to go toward energy savings and the stipulated improvements. 49% can go to resiliency. And so I think we've left a very broad approach there where folks can come back to us and demonstrate additionality to the community on a resiliency perspective, as well as from a climate energy savings perspective. So the short answer, absolutely. If someone wants to put together a structure around that, I'm sure we can work with you.
Excellent. Yeah, I appreciate the flexibility that you baked into this, and thanks for the presentation.
Excellent. Any other questions, comments, feedback, experiences?
All right.
That's great. Thank you
Well,
so much.
I'm reachable. And I encourage anybody who wants to learn more and reach out to me, and we'll work through it. There's a lot of other stuff we're doing, obviously at NYSERDA, in supporting local capital. We'll pass it off to Bill Peterson. He's with Amalgamated Bank, and he's going to talk about lessons learned in setting up not only just energy lending, but CPACE lending.
Yeah, hi. Thanks, John. I'm Bill Peterson. I'm the Senior Lending Officer at Amalgamated Bank. We are a 100-year-old bank that was originally started by the Amalgamated Clothing Workers Union in New York City. And we've long been a pioneer in socially responsible banking, and more recently in climate protection and impact lending. And, we 2 years ago, Amalgamated Bank had never done or heard of a CPACE or our PACE residential or commercial PACE lending. And we now have over $450 million in both residential PACE and commercial PACE combined lending. It's been quite an evolution for us. And, we're very bullish on the asset class. And I'll talk a little bit about sort of, what I think the important parts of us setting up our program were. And, some of the lessons that we've learned, over the last two to 3 years. I think the first and most important thing for a bank, and particularly a community bank, is really to understand the asset. When we first started, we weren't sure, it's kind of a strange animal, if you will. It's not a loan. There are no notes. There is not a borrower in a traditional sense. What you've got is a security that is basically a cash flow from voluntary tax assessments. That is the financing mechanism, and it's unlike a traditional commercial loan. Susan mentioned, this is basically a financing that runs with the property. So again, there's not an individual or a corporation, that is, an obligor, if you will, on a note in the same way that you would do a traditional commercial loan. And the fact that, what you've got is a stream of tax assessments over a 20, could be 5, 10, 15, 20, 25 years, typically 20 to 25 years for most CPACE assessments. And, you collect those, that you're somewhat at the mercy of the jurisdiction who's collecting those tax payments. Basically, when they collect their tax payments and they do the tax billing, that, you'll see the real estate taxes, you'll see other assessments, on that for streets, for sewers. And you also see on that tax bill then a CPACE assessment that's listed separately. But those assessments are collected by the local jurisdiction and then delivered to the bank, typically semi-annually, depending on, I know Florida as an example is annually, California is semi-annually. So you have to understand the jurisdiction that you're dealing with, understand what their practices are, but again, really understanding the asset. The other interesting thing about it, from an accounting perspective, when we first started, we were booking these, as loans and putting them into our loan portfolio. And at the end of our first year, our financial auditors came along and said, gee, these really don't belong in your loan bucket. You need to list them on your balance sheet as investments or securities. So we had to make that switch. So it's important to understand and discuss with your accountants, exactly how these are, what these look like on a bank balance sheet. These are, these types of financings are very document and legal intensive. So, you need to do your homework in terms of developing a relationship, generally with external counsel that has experience, to review all the legal documentation and make sure that you're comfortable, with what you're signing up for. And one of the things that we did, and I would recommend, we had any new product presenting to your board of directors on, starting a new product. We did a fairly extensive white paper, for our bank specifically. that really delved into sort of the history of PACE, explored again some of the nuances and the legal ramifications, and presented that to our board so that we made sure we really understood what we were getting into. The second thing in establishing, our particular program was really understanding what our risk parameters and our risk appetite for these kinds of PACE financings were. We think of them generally, in the real estate bucket. So, the tendency is to say, hey, we're going to do our PACE financings in a similar way that we would do a commercial real estate loan. And so things like what asset classes are you comfortable with? Office, industrial, would you do hospitality? Do you do medical facilities? So in establishing a program, you want to really, understand what types of properties, are you comfortable with for your CPACE program? What geographies? We started out, staying close to home. We have offices in San Francisco. We have offices in New York and DC. So our primary focus for that first year that we did was in the California CPACE program. And so we stayed close to home. Since then, as we've gotten more comfortable, with this asset class, we've expanded, and now, I know there are 36 to 40 states currently that have CPACE programs, and we've done a number across the country, of CPACE. One of the benefits of a CPACE program from a lender perspective is the secured position. As Susan mentioned, you are in, the catbird seat in terms of where you are in the, in the lien with the lien that you have from your CPACE program. So, generally you're second only to the tax assessment, and you're ahead of that first mortgage lender. And so, when we think about the risk of a CPACE financing, we're really thinking about what's the probability of default, what's the loss given default. And the beauty of CPACE is the loss given default is generally, approaches zero. While whatever the operation is, whatever that business, if you're financing a, hospitality, there are a lot of right now CPACE across the country, a lot of opportunities in hospitality industry, which a lot of banks won't finance, won't finance hotels. But with a CPACE, because of the fact that the CPACE LTV is generally between 5% and 15 or 20% of the value of the property, it's very safe from a loss given default perspective. And so we're always looking at the PACE LTV versus the combined or the total LTV with whatever first mortgage may be, in place. And each bank is going to have a different appetite. We set our parameters at a maximum 30% PACE LTV and a maximum 80% combined LTV with any senior or, subordinate financing first mortgage lender. And as I said, when we think about it, you're quick to say, gee, because the loss given default, because of your low PACE LTV is so strong in these, I think you can't overlook the probability of default. So one of the things that we encourage, and that within our policy, we want to underwrite the operating business or the operating company. And we're going to make sure that, as we would a commercial real estate loan, if we were doing a first mortgage, we apply some of the same credit standards and underwriting standards for our CPACE as we would for a commercial real estate loan. Even though we're not doing the first mortgage financing, we're going to underwrite what the first mortgage, debt service coverage ratio is. So we come up with both a PACE DSCR, debt service coverage ratio, and a combined debt service ratio. And, obviously always the PACE LTV and the PACE DSCR are very low and tend to look very good. But again, because of the fact that if the business has a problem, if the property isn't generating enough cash flow to make those tax payments, it will go into default. And again, it can be a long, depending on the jurisdiction, you're a little bit at the mercy of their policies in terms of when do they start the process of a defaulted tax lien. It can take a year, 2 years, 3 years. So even though ultimately we feel very safe that we're going to get paid, there could be some lengthy period of time where that asset is, in default and not getting paid. Ultimately, we feel pretty strongly that, you're going to get paid. And when we were talking about the first mortgage lenders, their ability to foreclose, as a PACE lender, generally in a default scenario, if they're defaulting on the tax assessments and the PACE, it usually means they're defaulting on the first mortgage. Because the PACE and the taxes are generally less than, the first mortgage payments or some accrued first mortgage payments. Usually the first mortgage lender is ultimately, through their foreclosure process, going to bring a PACE lender current. And that's been our experience. In those few instances where there have been problems, on a CPACE transaction, the first mortgage lender is generally, like they would on any other CRE loan, if they go through their foreclosure process, they're going to bring the taxes current. They're going to bring the, the PACE assessments current as well. In terms of lessons learned, I think, the first thing is just to understand that these CPACE transactions are not without risk. We've had in, our experience, one CPACE transaction that actually went into default. It's been a couple of years where it's been in default, and we've been working with the local jurisdiction, through their tax lien process and their sale of tax certificates in order to be brought current. Again, I think the underwriting of the underlying property and what that cash flow property is important. I mentioned the fact that it's important to know each jurisdiction because, it's different in California, and in certain counties in California, each jurisdiction may have their own process and procedures. So it's important to understand that when you get into a CPACE transaction, understanding the municipality or the county, depending on who the tax jurisdiction is, what their process is, for a tax delinquency, what their billing process is. I think that, it's, as in a commercial real estate transaction, it's very important to establish, you want to establish relationship with good developers, for any CPACE project, just as you would look at any other loan, where I think the real risk is with working with developers or property owners that are inexperienced. And again, because generally these are construction loans, you want to make sure that you've done your homework on who the developer is, who the contractor is, what their experience is in developing these types of projects, again, and making sure that you're applying, normal and proper underwriting guidelines. And I think, again, in terms of that, the overall portfolio, I think generally, I would say start slow. You will learn as you go along. You will identify specific risks, because it is an investment and rather than a loan on the bank's books. Things to be thinking about is how do you account for loan loss reserve? Does it fall in your typical loan loss reserve, or is there a separate reserve for investments that your bank may have? In terms of approval process, when we first started, we were running these through our credit committee. Again, the same way we would do any other commercial real estate loan. Over time, now we've moved that to approval through an investment committee rather than a loan committee. So again, really establishing before you get too deep into this, what the process and procedures and what the impacts are going to be given the unique nature of these CPACE loans. So I will stop there.
Bill, can I just jump in real quickly,
Sure.
Given that there are several municipal, EIC's municipal members on this call. I just wanted to reiterate that in New York, EIC is the program administrator. We bill the property owner, not the municipality. So the municipality opts into our program, signs a municipal agreement with EIC that clearly governs our responsibility. So once the municipality opts in, they're finished with our program. It's on EIC to bill. The money is sent directly from the property owner to the capital provider. So it's a bit more simple for our members than it is in other states. They don't touch the money, and it's one of the many ways that we're protecting them from ever being exposed to CPACE, because they have nothing to do with it. So they had no role, they never touched the money, they never forgot to bill somebody. It's all on us. So I just wanted to clarify that. Thank you very much.
Great. You know, that's a good point. I would say an enhancement over many of the other programs.
Absolutely, and it's recognized nationally as such, and there have been efforts from other states to sort of copy what we're doing for those reasons.
Fantastic. Bill, any closing thoughts? Anything to add? Any questions, comments from anyone?
Yeah, I would just add that, you know, as an asset class, we're very bullish on CPACE. You know, the projections for the use of CPACE to finance energy efficiency improvements, you know, is through the roof. And, you know, particularly for banks, you know, in our current economic environment where most banks are pretty flush with liquidity, looking for, you know, strong, secure, good yielding assets, we think CPACE is, you know, a very good way to go.
Thank you, Susan. I have a question. What are you thinking in terms of secondary liquidity for assets that are accruing?
We are not accruing assets. We're a program administrator.
No, I know that. I'm just saying in terms of, is there a thought about like bundling, having an opportunity to bundle CPACE loans with various lenders and do a secondary liquidities like secondary bond or something, or securitization? I know you guys are administrator in this, but I'm just thinking in terms of concentration levels that may happen at some point when people are doing a lot of loans. What is the thought?
Oh, sure. So you're asking if in terms of our lenders' business.
Correct.
So some of the CPACE lenders hold these on their own balance sheet. Some sell the assessments in the privately to insurance companies that hold them to duration on their balance sheet. And other CPACE lenders securitize, and these are sold as ABS and traded more publicly. So it depends on who the lenders are. I think that the small size of the CPACE industry has focused certainly a large percentage of these lenders on having one off-taker. For example, they may have, you know, think of a big insurance company as the entity that buys all of these assessments from them and then holds those to duration on the balance sheet.
Mm-hmm.
But as CPACE assessments become more frequent and there's a greater volume, you'll probably see an uptick in the securitization. And I'm unclear, and I wanted to ask Bill, when Bill talks about having over 450 million in CPACE and RPACE lending, Bill, Amalgamated is not a direct lender, as far as I understand. Are you holding these on your balance sheet and these assessments are generated by a specialty finance company? Or how does that work?
Yeah, so both. You know, we initially we weren't direct lenders. We are now, you know, have been a direct lender and will be a direct lender. You know, we'd like to be direct capital provider and originator.
Okay.
So, you know,
Great.
both, I guess, is the answer to your question.
Okay.
And we do hold, currently we hold everything on balance sheet.
On balance sheet, yep.
Yeah.
Well, we'd like you to participate in the New York program, so call us after this session.
Yes.
Well, that's why we brought Bill to talk about that.
Perfect.
We want
Thank you.
to encourage that.
John, you're an excellent facilitator. Thank you.
No, I'm not good at technical details, unfortunately. with Zoom calls. Question, Susan, has New York PACE loans, CPACE loans been securitized by any of the lenders yet? Have they gone into a pool that has securitized? So the question really begs to have the rating agencies weighed in on the structure or
Good
documentation?
question, yeah. So of course, being who we are, very experienced in creating financial products, that's one of the many things that you do when you're creating a financial product. So that's one of your stops. You bring your program or what it is you're doing to the ratings agencies before you launch it, right? Because there would be no point of doing something so stupid as to launch a CPACE program and have the ratings agencies say, we don't like how you do this. So that was all worked through before we even launched the program. And one of the many things that the ratings agencies like about our program is that nobody touches the money, meaning the municipality does not collect, EIC does not collect the money. So, so the answer to that is yes. And we are actually in many ways preferred. And one of the things we're working on is getting a superior really premium for our assessments in New York State because they are green assessments rather than assessments that include things that don't save energy. We have third-party independent verification of that, whereas other programs do not. So we're far more focused on data and on proving that our assessments do save our carbon. And also, we want credit in the markets on our securitizations for the fact that we don't touch the money. And that is a risk and a negative. No offense to the municipal people on this call, but municipalities are not, they shouldn't be put in the position of the administrative burden of placing this additional lien and then worrying about collecting it. Their software systems don't always accommodate it. And the other thing, it's a little bit technical. These CPACE assessments can be refiled and renegotiated, meaning if a hotel property is unable to pay their CPACE assessment because of the pandemic, the loan actually gets restructured in terms of the amortization schedule and so on. And the CPACE capital provider will allow the hotel property owner to not pay the assessment for 2 years until they can get back on their feet. So imagine what would happen to a municipality if the finance company came and said, well, we want you to change the way you put this on your tax bill for the next 20 years. And we want you not to charge this year and don't charge next year except for this amount of interest. I mean, it would be a disaster. So that's the other thing we want credit for, right? This is the next generation and how assessment financing should work. Municipalities are the only reason it's available. They are the ones that everybody needs to worry about taking all the burden and exposure away from. And there should be a centralized program administrator that's a professional administrator, not a government entity, making sure that everybody is protected and people that are in the position to do the other 500 things that we're not going to talk about on the phone that go on in CPACE. So that was a long-winded answer, but.
No, that's appreciated. And just could you comment which credit agencies have reviewed it? Okay.
Well, DBRS Morningstar is the leader, but Kroll also rates these. S&P is trying to step in now in that it's a growing business. But I would say the leader is DBRS Morningstar, and they merged, I want to say probably 2 years ago. So it used to be the two, and now they're sort of one.
Yeah, no, I appreciate that. And I just want to plug in for our loan loss reserve. There is possibility for a business model which may be having CPACE on it that you may be able to apply for some kind of a coverage. It would have to be, we would have to see the proposal, but that's an additional element, and maybe that's just for that period where the loan goes, yearly assessment. There's only 1 year assessment at a time that's due, but in the event that it's not technically a default, a shortfall or something, maybe there's a way for us to work with the lender on that as well. We're exploring those ideas in the residential PACE right now.
Yeah, John, that'd be an exciting enhancement model to investigate further. Nancy Merton, I think you raised your hand. You had a question.
I did. I appreciate that the local governments, are, the risk is removed from them, in this whole process. But I'm wondering how, the rest of us who are, want to see clean energy financing happening in whatever manner it, is best for the building owner. How can we promote that? How can the IDAs promote, the use of this tool? Is there, I've heard that in Franklin County, there's been some reluctance from some of the banks to want to participate. And can they block the use of CPACE financing in a municipality where it's enabled?
They can't block the opportunity in the municipality, the banks, Nancy, but they can refuse to give lender consent if they're the senior lender on a particular property. So they can certainly refuse to give consent to any property owner that has a mortgage from that bank. So that's how they can block it, because I think nearly all commercial programs, there are a couple of exceptions, but those exceptions are frowned upon really by the industry, do require this lender consent. So I think the best way for folks in Franklin County or any other county, if they want to sort of get the word out about CPACE, is, certainly reach out to us. We're available always to talk to small groups of people and are happy to do it for any municipality that has one or two banks that would be interested in, speaking to us about the program. And, again, we just want to be totally transparent so that people feel that they have all of the information they need to make the right decision for their business.
I got a question for you, Susan. This came out of a comment that Bill made about working in California with some of the individual counties out there and the customization that he may have experienced. When the municipality signed the municipal agreement with EIC, is there any opportunity to have customization, or is it pretty monolithic that makes it more palatable for these mortgage lenders?
It's uniform. It's a uniform statewide program. And it's uniform so that we can operate the program. So if you think about, if you're a lender and you wanted to perhaps, create CPACE financings in New York State, and there were all of these different rules, depending on what town, city, village, county you were in, you just wouldn't get any uptake. So our program is a uniform program. We provide municipalities with a template local law. In terms of, some customization, we do allow that. We try to keep it as a side letter to the municipal agreement. For example, if municipalities don't want to allow CPACE for, think of whatever it is, you can only put solar on brownfields. You can only, whatever it is, they can have a side letter that tells us, makes a few things clear about how they want it to be run. But we prefer to have it in a side letter so that all of the agreements, the template agreements, are standardized. Then we reduces our legal fees because everything goes through our counsel. And it just would get to be really expensive. So they can customize if they have like certain things they're against, certainly, gas stations, or that's all excluded anyway. But for the most part, we try to keep it uniform so that everybody can kind of understand what the program is and what it does.
So I just want to make sure the lenders on this call know that if there is a New York City is a separate program about to be launched versus the EIC statewide program. So just keep that in mind.
Yep. So far, New York City is still threatening to try to stand up their own program. We're waiting to see their documentation, but I think we all realize that New York City tends to want to do something different than the rest of the state.
Yes, it's only taking them. Yeah, I think it's been in process for what, 7 years or something like that.
I think so. Yeah.
Yeah, that's my next call later this afternoon.
I want to be mindful of the time. We're at 11 now, so I think Jen's got a few closing words for us.
Yeah. Thank you so much. You're right at 11 o'clock. like I said, I've got probably 5 pages of notes and follow-up thoughts. Closing thought for me is, first and foremost, thank you so much. The collective experience and knowledge of our 3 guests is staggering and inspiring. In our opinion, is the beginning of a conversation, or maybe in the early stages of a conversation that's been begun. And I would be very interested to follow up with our IDA participants and lenders on the call to step it back out to, okay, we've got a lot of information and nitty gritty now. How can we bring this message to North Country lenders as we move forward? So I will be following up with folks. Any other thoughts or feedback that anybody has over time, we are always happy and welcome to hear it. And again, thank you so much, everyone. And we will certainly be in touch in the near future.
Thank you. Thank you for having me.
So Jennifer, can I just do one more closing remark?
Very briefly.
Yeah.
Yes,
don't leave yet. So, we are really focused on getting local capital deployed. We're working with credit unions. We've got our loan loss reserve. We want to work with you. There's no cost associated with this. If you want to lend to low-income communities and and support that resiliency framework in your community, and there's a program you think you can come up with, come to us and talk to us about it, and we can help provide a loss coverage up to 20% or more. I mean, you're not going to be lending to anything that you expected losses to be more than a few basis points to start with, but this will work really well with the regulators especially. And on June 10th, we will be having a lender webinar with DFS, the regulator in the state. And so, I encourage you, reach out to us. We want to get more local distributed capital out into the market, and we want to support low-income communities and really the marginalized or justice communities especially. We're open for business. You should take advantage of it.
Excellent. Thank you, John. And we'll be sure to put the link to the registration for that webinar in our follow-up email with folks.
Yeah, absolutely. Excellent closing thought. And we're on it, John. So thank you so much.
Thank you.
Great. Enjoy the day, everyone. Thank you so much.
Thank you all.
Thank you.
Good one.
Bye.